Right, hello everybody. Thank you for that intro, James. Not least because he's referencing my daughter's championship football side that Cambridge Partners sponsored this year. So they had a great year, only one loss in 18 games. So anyway, you're not actually here to listen to them, you're here to listen to us. That's me. What an interesting 12 months it has been. I'm going to talk a little bit about some of the interesting news stories for the last 12 months. I'll touch on investment returns. I'll then look at the red versus blue political debate, both here in New Zealand and overseas. And then I'm going to touch on interest rates before I wrap up and hand over to Andrew. Wow, 12 months. Well, I couldn't talk about the news of the last 12 months without discussing the COVID-19 pandemic. We all got to see a lot of our Prime Minister Jacinda Ardern and the previously relatively unknown Director General of Health, Dr. Ashley Bloomfield. We all learned to wash our hands in soap and water for 20 seconds and look for hand sanitiser wherever we saw some. There was some out the front, if you've not had any for today. We also had the first majority government elected under MMP in New Zealand. And we had what is being described as the COVID crash, which was a precipitous drop in February and March before governments and central banks around the world responded with massive fiscal and monetary stimulus to have this bit of a V-shaped recovery up here. And then we had a decisive or disputed, depending on which press release you listen to, US presidential election. What does that mean for returns? Well, this has certainly been an interesting ride. After a fairly normal-looking, sedate beginning to the last 12 months, we then had this precipitous drop in February and March. This was followed by an almost equally opposite increase through to June, and then a much more steady sort of rise post that time period. I acknowledge this is a bit of a messy slide, but you should all be getting a bit used to this by now, either through this briefing or our updates. Top of the pops for 2020 is New Zealand shares. $1 invested in November last year would have grown to around about $1.12 as at the end of this year. That's a pretty good 12 months. Now in second place, another New Zealand asset, this time New Zealand fixed interest. The S&P NZX A-grade corporate bond index, which is basically the credit-rated bonds on the New Zealand stock market, would have grown to about $1.05. Now, you would have seen in that initial slide that not all of the asset classes were actually above water by the end of this 12 months. Some of them were still below water. Now, this slide is a 50-50 mix of cash and fixed interest and shares. Now, at the end of 12 months, that would have been worth around about 98 cents. Not all the way back, but pretty close. But I always say that 1 year doesn't actually tell you a lot. 3 years and longer is a much more meaningful time period to think about things. Now this is interesting. Almost every single asset class is up above $1. There's one that's below. Now this March drop still looks pretty grim, but in the context of that overall 3 years, less so. Top of the pops again was New Zealand shares. At the end of 3 years, $1 invested 3 years ago would be $1.52. Now in second place, and this is really interesting for those of you that like math, is a 50-50 mix of cash and fixed interest and shares. The reason that's interesting is that a diversified mix of assets can never be top. It's just not mathematically possible. But a mix of all of these assets to come in second, growing to around about $1.21, that's a pretty good outcome. Actually, that's around about the long run expected return for this mix of assets. That is despite, seemingly in spite of, a COVID crash, of a collapse in markets that at the time appeared calamitous. Remarkable, really. On to the fun bit. Every 3 years in New Zealand, every 4 years in the United States, we have this game of red versus blue, spy versus spy. Who will get to be the government of the day? Well, this year in New Zealand, I've already spoiled this, we had a decisive election result for Labor. We had the Greens trying to put in place a wealth tax to carve out a point of difference, ruled out by Labor. Not happening. We will have a new top tax rate. Labor campaigned on a new tax rate over 180,000 at 39 cents in the dollar, so that will happen. We're not sure when, but it will. But really, this election was a referendum on the government's response to COVID. And the conclusion of the general populace of New Zealand is that they did well. Otherwise, they wouldn't be the first majority government under an MMP history. Now, of course, they brought the Greens along. Lots of people have got lots of views on why they might have done that, but they did. We've been asked, well, what does that mean for markets? And it's a valid question because the media is out there telling us that it's either going to be good or it's going to be bad. So what's happened? Well, initially, remembering the election was on the 17th of October, not so good. As at the end of October, markets had fallen, or at least the S&P, the New Zealand stock market, had fallen by 3%. However, there was also a bit of a US election around about here. So there was a bit of uncertainty. Since that time, markets have gone up. So, since the election, 17 October until the 11th of November, when I put this slide together, the S&P NZX 50 has increased in value by 2%. Well, that's 1 month. I said 1 year wasn't particularly informative, so 1 month can't be right. Well, this was fun to put together. This was really interesting. Now, I have to concede there's some fairly pale mail and staleness on this particular slide, but this is the growth of $1,000 invested in the New Zealand stock market in 1961, in real terms. That is after inflation. Now, what we've done here is obviously the blue team is national, and here in the red, we have Labor-led governments. Now, our hypothesis, as stated by the media, is that markets do better under centre-right, that is, in this case, blue governments, than they do under centre-left or red governments. Well, what do the numbers say? The average annual after-inflation return of New Zealand share markets under a national-led government, 10.32% per annum. That's pretty good. What about under a Labor government, I hear you ask? Or I could have. 3.16% per annum over this whole time period. Well, that looks pretty decisive, doesn't it? Shut the doors, ladies and gentlemen. We're in for a bad time in markets for the next 3 years. Or are we? Labor had the misfortune to be presiding over the New Zealand economy during this time period, which is Black Monday. That's what the 1987 stock market crash is known everywhere else in the world. They also had the misfortune of presiding over New Zealand during this time period, which was the global financial crisis. One of 3 major financial crises over the last 150 years. 4 if you maybe include COVID. What happens if we strip that data out? Because I'm a great fan of David Longy. I can still remember the first time I heard "lean in, I can smell the uranium on your breath." But I don't think he's responsible for Black Monday. Helen Clark, exceptionally impressive individual. Our first elected female Prime Minister. Again, not powerful enough to be responsible for the GFC. What happens to those numbers when we split that data out? I wonder if the story will change. It most certainly will. Under a Labor-led government, excluding the Black Monday and GFC crashes, the returns go up to 12.48% per annum. Now, the returns under a national-led government also go up because the data series is a little bit shorter, but this time only to 11.30% per annum. All of a sudden, whoever the government is doesn't seem like it matters that much. Interesting. But this is only to 1961. I like data, and that's just not enough. So, where do we go when we want data? We go to the US, because the US has lots and lots of data. Now, this is a place to test our hypothesis. Now this time we've gone all the way back to 1926, when the president was the very coolly named Calvin Coolidge. Now, one of the tricks here, ladies and gentlemen, is you actually have to swap colours. In the United States, the Conservative government, in the red, is the Republicans. In the blue is the Democrats. So that's the centre-left equivalent to the centre-right Republicans. Now, what do the numbers say over this long time period, from 1926 to the end of September 2019, when this fellow was still president? Well, under a Democratic president, the average returns of the S&P 500, which is the 500 largest companies in the US, was 14.9% per annum. That's pretty jolly good. What about under a centre-right Republican president, remembering our hypothesis, which is markets do better under a centre-right government? Not so much. Well, that's interesting. Now, 9.1% plays 14.9, that seems pretty compelling, doesn't it? However, this data series also has Black Monday and the GFC. I'm calling that the Bush effect on this slide. Presidents George Bush and George H. Bush both had a fairly awful time in terms of their share market performance. If we adjust for this data, actually the return differential decreases significantly. The returns under Republican presidents go up by 4%. Again, the differential doesn't seem like it makes that much difference. However, and I apologise for this move, ladies and gentlemen, because it is a trick that I frequently pull. It's all about the data set. It's all about how much time you have. Now, going back to 1926, it looks like you want a Democratic president to lead your country and have a better market in the United States. Well, if we go back to 1853, there is no statistically significant difference in the outcome for the S&P 500 regardless of who the president is. Maybe it'd be different if there was a Libertarian or a Green, I don't know. But when there's a Democratic president or a Republican, no difference. This number's a rounding error. Well, that's interesting. What I think it means is that maybe we don't need to listen to the media when they're telling us that one particular party is going to be better for markets, because the evidence suggests that it won't matter. Now, something that might matter is interest rates. Now, this won't come as any surprise to any of you. Interest rates are low. In fact, they were low 12 months ago. They are now very low. The 10-year NZ government bond yield is 0.84%. That's actually an improvement in terms of rate. Last month, it was 0.54%. That's a fall of 0.55% over 12 months. US 10-year government bonds yields, 0.96%. That's a fall of 0.88%. That's also higher than New Zealand government bonds over the same time period. That's interesting. 6-month term deposits, 0.93%. That's a fall of 1.72%. Isn't it just like the banks to fall more than anyone else in this particular environment? Now, the averages are interesting. The long run average of 10-year government bond yields in New Zealand, 7%. However, that includes a time period when they started at 17%. Some of you in this room will remember those sorts of rates. If we adjust back to when inflation targeting really had a tool in New Zealand, when the official cash rate came in March 1999, it becomes 4.78% average. The long run average of the US 10-year government bond yields, 5%. The long run, or the 1999 average of 6-month term deposit rates, 4.79%. Interestingly, that 6-month term deposit rate is also currently the 5-year term deposit rate. It's a bit depressing, really. The official cash rate, the benchmark rate by which the banks supposedly benchmark their lending and term deposit rates against, now 0.25%, down 0.75%, the lowest it has ever been. The average of the official cash rate over its entire lifetime is 4.09%. How's that for some context? 4.09% plays 0.25%. Interest rates are very low. And we have to respond to that. Now, James touched on something earlier. He mentioned investment options have become wider, broader, deeper with this globalisation of the world and with our access to technology. We, as your investment committee, are currently working on a project to respond to these lower interest rates. We will be making some changes in your portfolios. We will be communicating about those changes before the end of this year. I've now said it to you, so it's going to happen. No matter what the colour, in the US or New Zealand, New Zealand Inc., Global Inc. is going to do okay. The President, the Prime Minister, as much as they matter for lots of things, doesn't matter for share market returns. That 3-year slide showed you the importance of staying diversified. We don't know in advance what's going to be the best performing asset class or the worst, but we know if we can have a predictable, diversified experience, we will get the outcome we need. And I don't know what investment returns are going to be for the next 12 months. I can tell you in 12 months' time, and I happily will. But what I can tell you is how we will respond to those investments. And we will stick to the plan. We will stay invested. Now, that doesn't mean doing nothing. That doesn't mean not changing anything. As I've just said, we will be responding to the low interest rate environment. We will be communicating with you before the end of the year how we're going to respond. But what we will also be doing is staying invested, even when we are uncomfortable. Those of you that were clients at the beginning of the year spoke to your advisor during February and March. I know because I spoke to all of my clients, and I know that all the other advisors did too. And actually, none of our clients responded by wanting to sell their investments. They were all philosophical, you were all pragmatic, you were all experienced investors who knew exactly how to respond. Some of you even put more money in and rebalanced. You were rewarded for that discipline. That will remain the case moving forward, and we will continue to remind you to stay disciplined. Thank you for your time. I'm around here.